Our next speaker is Zach Manis. Zachary Manis is a senior analyst at ElliottWaveTrader.net and one of its founding members. As the second analyst to join after Avi Gilbert, Zach now co-hosts the Stockwave service with Garrett Patton and leads the Beginner's Circle webinar, helping traders apply wave analysis to U.S. stocks. Zach's topic today is combining Elliott Wave with ratio charts for an added edge. Over to you, Zach.
Thank you, Jody. It's great to be here again, back so soon. Did you want me to share my screen?
Yes.
Okay. So, as Jody said, the topic that I wanted to discuss with you guys today was how I've been using ratio charts just for a little bit of an added edge to our individual counts on things in stock waves in the metals and mining and agriculture service, and how we kind of fit those into our constant search for rotation opportunities. Managing a service that deals with individual sectors and equities when things might seem at large degrees, at least for the broad market, very close near more significant tops. But not everything moves the same all the time. And so looking for those opportunities where something is going to outperform, and whether that is, so I guess before one of the important things to note before we dive in and start talking about some of these ratio charts is that for a ratio chart to change, it doesn't necessarily mean that the instruments being discussed have to move in opposite directions. So the ratio chart moving higher merely means that the first instrument is outperforming relative to the second. They could both be going down just at different rates of travel. So that's important to consider when we look at some of these things. People say, how can you say that gold and silver are going to go in opposite directions? Well, we're not. Gold and silver do tend to follow very similar paths with each other. We treat silver kind of as the overactive baby brother sometimes to gold. But here, the first ratio chart that I wanted to look with you guys is this gold and silver ratio, which I'm showing a significant bottom that happened to actually be at a 764 retrace recently in January from this move down that we were looking for. I recently switched to GLD to SLV. And one of the reasons for that, and you'll see a lot of these ratio charts, I'm not looking at the SP, the ES futures or the GC futures, or things like that, because with continuous contracts, when they roll, and particularly in our current interest rate environment, when they roll, there's been a pretty decent jump in price. And so that causes distortion in the charts. Whereas if you switch over, if you're for the purposes of the ratio, not something that, not trying to trade futures based off of a GLD chart overnight, but for the purposes of looking at larger trends, we find that the ETF versions have those things smoothed out a lot better. So we were well over 100 to 1 in the ratio of gold to silver, and had been noting that we had a five-wave move up into the extreme price highs that we saw in 2020. And then we had a corrective bounce after this initial move down, and we're looking for a C wave down to take the price ratio between gold and silver down towards the 50% or 50 to 1 ratio. And we sliced a little bit below that to get down to the next fib instead of holding at the 618, which is perfectly acceptable, and have reversed very, very strongly off of that low in what looks like a pretty impulsive five-wave move up. So similar to the way that we look at other commodities, though, we're not always necessarily looking for longer term continuous trends to be established in a lot of these charts. My default approach to them is to treat them more like oscillators. So while I have a 1, 2, and a 3, and even there's a 4, 5 here on the chart shown, I'm really just treating these as opportunities for a measured move and then looking to see how much it can establish more from there, but not necessarily treating this as maybe a primary degree wave two bottom and the start of a much larger bullish trend, but just looking for how the implied movements or relative movements from the ratio chart can help us in analyzing those individual instruments or the if we're looking at sector ETFs, which we will later. So we have this more impulsive looking move. We have a corrective retrace to a 50% fib and then a reversal off of that, then another corrective retrace to another higher low. So in the very short term, as well as in the intermediate term, we have bullish setup, well, bullish in the ratio chart for gold to perform better than silver. Which, if we know anything about the recent run up, we certainly saw silver go bonkers relative to gold, even though both of them made significant new all-time highs. And then off of that recent high in silver, we saw a much more violent reversal in gold, although both of them dropped pretty significantly on at the beginning of February and end of January, beginning of February. But silver made a substantial lower low, which accounts for this fifth wave up here. So I'm looking for the ratio to head back up into the 90 region over the coming months. But let's take a look at some of those individual charts. First, I want to take a look at the gold chart. And let's first go to GLD. Because this is just a much more simplified view that has a lot less subwaves here. And then we'll kind of talk about this and then maybe look at it on the GC chart before we look at silver. So as we said, gold had an initial drop down into the beginning of February and then has a corrective bounce to a lower high off of that low. Pretty high bounce, certainly relative to silver. It counts best, in my opinion, as a WXY. And then we have a possible start to a C wave, but so far the initial move down probably counts best as three waves. And this is acting more like a possible larger ABC. Maybe this is wave one of an ending diagonal. But as we'll see, it is possible that this is trying to fill out a far more muted ending diagonal for that C wave, maybe as a running flat where the C wave does not make a lower low than the A wave. And the reason why I say that, even though we didn't even get to a 382 fib here for this possible initial drop as wave one, is that this does fit best in the way that we're counting silver. And also, based on the ratio chart, this allows for both gold and silver to track together. But if we are filling out a more muted version of this C wave in gold, then that's another way that gold can, in the short term, at least outperform silver, even though they're both moving down together. So with that in mind, let's jump over and take a look at the silver chart. In the silver chart, as we said, silver got this significantly lower low relative to the beginning of February. But similar to the way that I was showing the count in gold, counting this as a WXY for this B wave. The alt here is I have an orange, and I try to avoid putting alts counts on my chart and clouding that up. But I like to show that particularly when they both are in the same direction and there's just some nuanced difference there, that I'm more willing to entertain and talk about that alt scenario. Technically, we do have a corrective retrace here if this is part of that alt orange wave one, which would be that bigger ABC down for wave one that we we're talking about in gold. And off of this low, even though we only have three waves up, we have a three-wave move down, so this could be bullish support. So I would be looking for a corrective retrace as a wave two and something bearish. But if at that point it started to get over resistance in this 90 to 95 region, then there is a risk that this was all of the fourth wave, even though it's not a clean, reliable, completed fourth wave count. And this is part of either an A, B, and a C wave in the fifth, or 1, 2 of an ending diagonal fifth wave. But right now, we are following an ending diagonal pattern for the circle C wave of wave 4, where the initial drop down was all of a wave 1. The corrective bounce was all of a wave 2. Right now, we're working on the A and the B wave inside the third, and then we'd be looking for a 4-5, possibly holding into that 7-6-4 fib, which is a much bigger percentage move down relative to gold, but very similar to gold holding that more muted fib extension for its C wave. And this would still allow silver to still be within a normal fib support region for this to be a fourth wave and to head on up to new all-time highs from there, maybe with gold outpacing it at that point to continue to outperform on the ratio. That it doesn't mean that silver doesn't make new all-time highs over the highs that it hit in January, just that it is not getting as much more relative new highs that gold might be making for a fifth wave up in gold. Gold, I'm actually counting it 1 degree larger, but here you can see that those counts can be very, very similar. If we can't make a higher high here into the 84, 85 region for this B wave and instead start to drop lower, that's where the count would shift more in favor of this alt orange, where this would be A, B, 1, 2, 3, 4, getting a fifth wave down of the C wave for that orange wave 1, and then looking for a wave 2 bounce, and then filling out as a deeper 4, which would still be pretty normal in terms of fib extensions for a C wave based on the orange, but would put it in jeopardy of breaking below more reliable support for that fourth wave in silver. So that's a look at the two main metals. We also look at copper and platinum and palladium as well as uranium, and sometimes rhodium and titanium and other stuff in the metals mining and agriculture service. But the next ratio chart that I wanted to talk about was the GDX to GLD chart. So this is the GDX we just use as the main mining index, but one of the things that we might take a look at if we have some time is we also, in addition to ratio charts, we put a lot of emphasis on equal weight charts, both in stock waves, looking at the QQEW and the RSP, and in the miners, metals mining and agriculture service, we look at the TXGM. That's because the makeup of the SPX, or in this case, the GDX, is very heavily skewed to a couple of names making up a very significant percentage. And so while it's important to look at those big names as drivers and that because they make up a significant percentage, the way that they move has a bigger impact on the index and in the sector itself, which then has an impact on all of the smaller names. Sometimes it doesn't give you, sometimes the bigger picture that you're getting from some of those smaller names that are less well represented sometimes gives you better clues as to way the entire sector is going to go, rather than a more narrowly focused look that you're getting from just a Newmont or a Barrick or a Kinross or something like that. So this is zoomed in on a 2-hour chart where we have a higher high made as 3 waves up. So this is even higher than the high relative that gold made relative to silver. The GDX to GLD made an actual higher high, which GDX actually did make a higher high in dollar terms as well, but as part of a wider flat for a fourth wave. Here, counting it at the same degree on this ratio chart as gold. In the GDX chart itself, it actually counts as a smaller degree of wave 4, ideally, and then inside a third, and then getting another 4 or 5 up before it's at an even more significant top. The ideal count here, based on the ratio chart, this little consolidation was too small to be a reliable wave 2. So this counts better as a larger ABC down for wave 1. This was even pretty small for a wave 2, but the only other alternative that I can really reliably look at is maybe this was the wave 1 and this was an expanded flat for the wave 2. But filling out as an ending diagonal where this bounces the B wave, and then filling out more of a third, and then it bounces a fourth, and then an ABC down for wave 5 into that normal support region that we look for a fourth wave. And it's nice that that fits very closely with what we're looking at on the silver chart, in addition to matching the way that we're counting GDX itself. But when we do zoom in on GDX, there's a little bit of a nuance difference there. Oops. So that's actually my alt on GDX itself, because this consolidation was a little bit more reliable as a wave 2. And fib wise, that was already close to a 618 fib for the inside the C wave. And so the alt is a little bit more bearish here, where counting it like that ratio chart or like silver, where this is just a micro B wave inside the third, and then it's going to fill out another 4-5 lower for that C wave. Still within normal support, but filling out this as a fourth and then a fifth wave, holding a little bit more as just a wide flat, more on parity with the low that was struck at the beginning of February, would be a little bit more ideal in terms of the fib structure inside this C wave. But some of those individual names lean a little bit more one way versus the other. So I mentioned like Newmont and Barrick within that. Um, Starting got a little bit higher there than the microwave 4 to get one more low as the C. So that's starting to lean more in favor of the little bit more bearish, where this is wave 1, this is wave 2, this is the A and the B inside the third, and then you're going to need another 4-5 that's going to head a little bit lower, possibly down towards a 1382 or maybe even a 1618 fib for that circle C wave, and then get another big bounce from there. Barrick as well, a little bit higher than that microwave 4 should have been. So starting to lean more again towards the alt yellow here, where this is a B wave. And then we're going to get a C wave down for a little bit more extended of a third, and then the 4-5 possibly down closer to 36 before we get another bigger B wave bounce. So a lot of the individual, also another thing to note is that a lot of these individual miners, this looks like only an A wave inside a larger consolidation, and they're going to need another bounce and then lower. Whereas other names look like they should be heading up, like GDX itself, to make a fifth wave of another high. So some of those other names that look like they can be a little bit more short-term bearish, where this might only be working on a wave 1 and a wave 2 inside an ending diagonal for the C wave. AGI, IAG, another one that has that same kind of look, where it hasn't come down enough to reliably be further along in that C wave, where this initial ABC down can just be a microwave 1 working on more of a bounce as a microwave 2, and then can chop down a little bit deeper in the rest of that ending diagonal. So I mentioned TXGM. Take a look at that before we move on to a couple of other charts. So TXGM fits with a number of the individual names where it really counts better at that the higher high made at the beginning of March was a slight extension of the prior fifth of wave 3. So the more bullish alt here is that this is an expanded flat trying to complete. But it really fits better with a new A, B, and a C wave starting, and this is actually fits more with that AGI or IAG charts that we just looked at, where this small initial move down can be just the wave 1 of a little bit more extended C wave to the downside. It doesn't mean that it has to take that long or fall quite so deep. It could be a pretty overlapping choppy move, but any further bounce here will look more like a wave 2 in a 1-2 start to the C wave down. So I didn't see, Jody, are you taking a look and seeing if there are any questions that come up that should be addressed as we go along? And then I'm just gonna just kind of change gears a little bit and segue into talking about equities in general from taking a look at from the metals and miners and looking at the SPY gold ratio. So this is a chart that we're looking for a significant move down into after a big move up that could count as five waves up into the 2022 high. We had an initial drop down and then a corrective bounce, and then following the evolution of the start of this C wave down, pointing into at least the top part of the normal fib support region that we look for, the 382 to 50% to the 61.8 retrace region. And we got really nice follow through in our third, fourth, and then a very extended fifth wave, which instead of holding closer to the top part of that region, really stretched close enough to that 50% retrace that instead of just being a primary A wave now, which would have been certainly the default if we held closer to the 1.5 region, but dropping down here closer to the 1.3s really allows for this to be all of a larger consolidation and maybe not only getting a B wave bounce. But we do have a nice reversal off of that extreme low, deep retrace that held a nominally higher low, and are looking for a move in this ratio chart that takes us up into the 170s, maybe 180s. And as I mentioned before, with a ratio chart, that it does not mean that those instruments need to move in opposite directions. And so for the SPY to get into the SPY gold ratio to get into the 1.7s to 1.8s, we don't necessarily need to see a significant movement up in SPY. In fact, if we saw most of that C wave down that we had looked at on the GLD chart, down towards the 390 region, that alone, with SPY pretty much staying right where it is, so getting net sideways movement would really get us pretty close to this 1.7 region. So that's one way of looking at the ratio charts and saying, okay, I have a very clear view of what one of these instruments should be doing based on Elliott wave structure. The other one, the chart is a little bit more ambiguous. As we said, equities in general, the S&P looks pretty extended off of 2009 lows, 2020 lows, April 2025 lows, April 2025 lows. It can count pretty complete at a lot of different degrees, but at the same time hasn't really broken any significant support levels yet. So could get further extension, or it could just kind of meander around and round out more of a top, but not really break any support and allow other things to rotate around that. And that's one of the things that Garrett and I are seeing. We do see some potential for extension in the broad market if recent lows hold, but nothing that really screams this is a major like starting point and a base for a big bullish market. But at the same time, there are a lot of good bullish charts out there. There are also some bearish charts that we've added as recent wave setups as well. And like the opportunities that we have in stock waves to play for that ebb and flow and look at things from both sides of the equation. So immediate support on this ratio chart is 1.4, and certainly holding recent lows from March are important for support in the broad market, as well as the downside structure in the start of that possible C wave that we were looking at in gold. So before we go on to talking about some of the other individual sector ratio charts, I wanted to take a look at, we had talked about our equal weights that we look at, which kind of a ratio of themselves in a way, where Similar to the S&P, we can count a possible move up off of April 2025, count a possible five waves up complete that completes a possible fifth of a possible fifth. But at the same time, so far off of those highs, we only have a corrective move. So in a more bearish, even in a possible bullish case, we can get more of a bounce and then lower. And then that could even be counted as an alt of this wave four, this ABC here, and allow for another extension, possibly up towards the 220 to 225, maybe even higher. At some point, extensions in Elliott wave become need to reevaluate what the prior part of the count is because they get to be too big to reliably be fifth waves of themselves. So sometimes that means that if your fifth wave ends up getting too big, maybe it's probably part of a third, and what you were counting as the one, two, three, four was actually just an unreliable larger wave one and wave two. I definitely don't think we're there yet. We certainly haven't even gotten more extension of a possible alt fifth wave yet. But the potential is certainly there if things continue to rotate and get feedback loops to the bullish side as things rotate around. So that is a quick note on at least the RSP as a version of the broad market. So one of the first of the ratio charts, in addition to that SPY gold chart that I wanted to look at, was the consumer discretionary versus consumer staples. So this is using XLY versus the XLP. And so one of the things that I think stands out when I look at a lot of these is that most of them count a similar degree five waves up off of 2009 lows or equivalents. But the subwaves are very, very different in between the sectors themselves, but certainly when we look at the ratio charts. So whereas most of these sectors follow some iteration of an impulsive move, more similar to the market, off of those 2009 lows at the larger degree, this chart in particular is a very big standout in that it looks very clearly like a diagonal structure. This initial move up, clearly an ABC for an A wave, and get five waves up for a proportionate C wave. This, as the wave two, is pretty small. Actually, it looks like we got a nominal lower load there that we can move that over to. Proportionally pretty small, but it is at least bigger than the intermediate degree B wave. So as the primary wave one and primary wave two, then we have much bigger than typical A wave. And really at the time, we were probably counting this as all of the third, and then this is a fourth wave. And then this could have been at least A, B, C up here for the fifth. But then when it got this extension higher, it really made it look more like five waves up as a bigger A, B, and C for the wave three here. So then we have a nice big wave four, which proportionately, at least as far as the diagonal goes, kind of dwarfs this primary degree wave two. But it is fitting proportionately relative to that very extended third, and actually came exactly to a 618 fib retrace, which is pretty typical for the fourth wave of a diagonal. Then we have another ABC up for an A wave, B wave that looks pretty similar on par to what we've gotten in the past as B waves, and then a possible ending diagonal for that intermediate degree C wave, where the consolidation that we just had into the recent March low fits perfectly as a fourth wave in an ending diagonal. So not a lot of consolidation here for the B waves inside these wave one and wave three. As you guys know, the big difference between a diagonal and an impulsive structure is that in a diagonal, all of the subwaves, including waves one, three, and five, are ABC moves. So we would be expecting this fifth wave to be an ABC, but it might get a pretty small, shallow B wave consolidation, more similar to what we got inside the wave one and wave three, as opposed to a much more pronounced B wave like we have here and here and here and here. So I thought that was very interesting. Lynn Alden, who we work with, and she helps us write where fundamentals meet technicals pieces, and using her more unique blend of fundamental analysis and looking at some fast graphs and things along with our technical analysis and Elliott wave charts. She really likes ratio charts as well, and particularly likes this XLY XLP in terms of what it says macro wise, as far as like a risk off and versus risk on. So when we look at the XLY chart itself, um, similar to those other things, we can even see, the potential to count all of a fifth wave up off of 2022, complete as an ending diagonal. But the alt here, well, not really the alt. The alt is just a wider flat for this B wave because we didn't hold as a reliable 1-2. So the real alt is that this was all of the fifth wave, but it does look like we are holding just as our wider flat from a B wave high, which implies that the trend is still more bullish to the upside, with getting stretched higher into what looked like an initial five ways up as a fake move there for what turned out to be the B wave of the B. And can get a five wave move. Maybe it's going to be a little bit more muted of a five wave up for that C wave, only heading towards a 764 fib extension, as opposed to getting all the way up here to the more typical C equals A fib extension, but holding as a decent flat consolidation, setting up for a potential move to new highs if we can hold support in that region. So one of the things that we do in stock waves is that on our Thursday webinars, we do charts of the day video on Mondays, Tuesdays, and Wednesdays that is recorded. It's usually about 7 to 12 minutes, and we cover 6 to 10 different names that catch our eye. Also going over if we added any new wave setups, those are usually included in that day's charts of the day video. But on Thursdays, we have a live webinar. And the webinar, it has a large the most of the time is spent handling member requests and talking about those charts. But for the first 20 minutes or so of the webinar, we usually pick a particular sector. We look at the chart as a whole, and then we drill down to some of the key components, names within that sector, looking for agreement in how they fit with the broader sector Elliott wave charts, or how they can possibly differ. Can they be standout? Are they going to be the main drivers of whatever move up or down, or could they possibly just be going counter trend? And then every 4 or 5 weeks, we also just do a review, looking at RSP and then all of the individual sectors, to just see where things are and look for rotation opportunities between those. So with you guys today, I wanted to pick out a couple of names from the sector here. But first, let's take a look at the XLP chart and see how that compares. So XLP, again, has a higher high over its primary wave 3 inside a larger cycle degree wave 5 off the 2020 low. But this higher high can count as just a larger A wave. And indeed, we're filling out as a possible C wave that allows for at least one more high here. So while we have a possible C wave move to the upside that could be proportionate to more of this, a larger to the entire A wave, XLP, while it has room for one more high, doesn't have the same extension potential that we see in the XLY chart. So potential for both of those to get some upside, even though XLY might outperform. So I wanted to take a look at a couple of the individual names. We'll start with a couple of the key holdings from XLY first. One of the top holdings there is Tesla. And Tesla is one of the charts that I am very, very bullish on. Even if we force the alt count here, where we're getting a more muted, more normal version of our circle wave 3 that already topped in orange, which brings the overall targets for our primary wave 5 and our intermediate 3 of 5 a little bit lower, we're still holding really nice corrective consolidation over the last couple months at a pretty high flat consolidation, with especially if we're counting that as the A wave and the B wave inside wave three. So the larger count here, I'm counting a primary degree wave 5 of cycle wave 3 for Tesla off of its January 2023 low. So we have the ABC up for wave 1, an ABC for wave 2. We have a very extended A wave of wave 3. And this bigger A wave than we typically see to stretch wave 3 up even higher is why I really like this still as just the A and the B wave inside this wave 3 of the C. So that this I'm looking at is a fractal to this larger A wave and the B wave, even though we're holding a nice expanded flat for that B, as opposed to getting such a deep retrace like we got into the April 2025 lows. So that's one bullish chart that we like a lot on XLY. Even if it is in the orange alt, we're still in the support region for that orange wave 4. Would look for a fifth wave and then another 4 or 5 up higher into the future. Another chart as one of the major holdings of XLY that we like here is Amazon. Let me zoom out here to a little bit bigger time frame where we can see the larger structure. So a note on my color coding here, sometimes I use purple or blue subwaves to emphasize diagonal structure for my members so that they know, okay, if I see a purple subwave count, then I know that the subwaves inside that should be ABCs instead of 5-wave moves. So even though this looks like 5 waves up for the A wave, that A waves can be either 3 waves or 5s. So they know that we're looking at a larger diagonal structure, and that tells us a couple of other things as well. While it looks like we have good risk reward for the C wave of this 5th wave, which fits nicely with that potential in the XLY chart. They do know that in terms of the larger degree risk skew, to be wary of that as we come into our target region and moving stops up along the way, because one of the things that we know about diagonals, in addition to allowing for overlap in the wave 4, although they don't always require it, and having subwaves that are all ABC moves, is that when an ending diagonal completes, sometimes the reversal out of it can be rather violent. So that means that you need to have your ducks in a row as you're getting into a potential major top, that you're not caught blindsided if that were to slightly truncate or just get a quick nominal higher high and not get fuller extension to the 320s or even 360 region and just start to violently break some support rather quickly. But nice structure here for more of a 5th wave in that parentheses wave 5 as an ending diagonal to complete a larger primary degree wave 3. Another one that I like a lot in that I think actually kind of bridges that gap between discretionary and the staples is MCD. But filling out a nice extended ending diagonal here for this parentheses wave 5, where instead of this being a much quicker ABC up for all of that 5th wave, we're getting a much more extended A, B, and then diagonal for the C wave to complete the C wave of that diagonal as well. So as long as that's holding support in the low 300s, looking for that to head up closer to the 370 to possibly even get a blow off top closer to 400 for McDonald's. Another name from this sector that I think stands out nicely with some near-term bullish potential or even intermediate bullish potential, even though it might have already struck its primary wave 3 top, is Booking, BKNG. So has a very nice ABC that's filled out. It does not count as large enough to reliably be all of the primary wave 4, more probably just the A wave of that larger primary degree wave 4, but should be working on more of a B wave bounce. Even possible that this is all of the B wave, but I wouldn't put it past us for this to get higher here as a B wave inside this B wave and fill out as a little bit of a wider flat. So enough for all of that B wave. It did get pretty close to a 50% fib retrace, but not reliably yet a confirmed start to this minor degree C wave in the larger bounce. But nice looking structure there for this to at least levitate more in the months ahead, and as opposed to any kind of immediate bearish setup. So now looking over at a couple of the names on the consumer staples, um, Coca-Cola fits very nicely with that McDonald's chart, actually. Even though it's filling out more as an impulse than as a diagonal, it's a very diagonally impulse. Even though technically there's no overlap, but looking for more of a fifth wave of wave three, and then from there another 4-5 for more of this bullish extension. Pepsi, I think, fits much better with the actual XLP chart. Here we can zoom out and see inside pretty much the same C wave, even though it's not making a higher high as the fifth. Here it's the C wave of a B at the primary degree. We have the same 1, 2, 3 holding support for a fourth wave, trying to get what's probably going to be an ending diagonal for the fifth wave of the C. But so maybe that's going to stretch out a little bit further here towards that 1, 2, 3, 6 fib. And this will be an ABC for that wave one and look something like that. But this might be one of the main drivers of that fifth wave up. Even if it's a choppy diagonal, it allows for that XLP chart to be heading up. Another one from this name or from this sector that can fit that same here. It's a instead of a C wave, it's a green parentheses wave 5, where this move down looks like it is holding as this green wave 4. If this is the start of a C wave, this is probably just the A wave. You need a B and a C wave of wave 2, and that would start to get over resistance where it's more likely to invalidate as a 1-2 start to the C wave. Typically, I say that the white count is my primary unless I specify otherwise. Here, because of what we see on the Pepsi chart and the XLP chart in general, and how this looks like it's more bullish off of this more recent low, I would give an edge to that green, what looks like it as an alt count here, but that fits with some of those other charts. So we do say each chart on its own, but we also like to look for clues that can give us a little bit more info on the best way to decode it. So it's not saying that because Pepsi is going up in a fifth wave, that Pepsi and Philip Morris are correlated together at a high ratio. And so whatever Pepsi is going to do, Philip Morris is going to do. It's just saying these are part of the same sector. They have some similarities in their count because of the way that we can read these charts using other charts to decode them a little bit better. We can lean, and because this looks a little bit more bullish than the start of a wave 2 corrective bounce in something more bearish, we can lean more to that green count in that scenario. MO, similar to Philip Morris, holding support here, actually looks a lot more like the McDonald's chart. So interesting that Coke looks more like Coke and Philip Morris look more like McDonald's. Coke and Alatria look more like McDonald's, and Pepsi and Philip Morris look like each other. So filling out as a diagonal structure for more of the C wave in actually just a wave 3, and then we'll allow for another 4 or 5 even higher beyond that. If this low were to break, then that's where it starts to look more like the alt yellow here, where this is a corrective bounce, even though it's at higher high as a B wave in what might hold a lot higher as an expanded flat at that point. Last name in this sector, and then I want to jump over and look at another ratio and then leave some time for some questions, is the metals chart or Mondelez or whatever, this MDLZ. I'm going to go ahead and delete this because we dropped lower than we probably should have for the wave 1. And if this is wave 2, it really should be all of that wave 2 because it already hit a 618 retrace. but it looks far more bullish than that. So leaning far more to this being the A and the B wave and starting a C wave up, which fits nicely with the XLY, XLP potential that we're looking at. So very bullish off of this 5450s low. Probably does need to try a retrace into the 56s as a small degree wave two. And that would likely just be as this awkward ABC of a Y wave in a wider version of this primary wave two, and then we would restart the C wave down from there. Another chart that I wanted to quickly glance at is the XLK XLU. So not quite the same as discretionary versus staples, but another, XLU is usually viewed as a more defensive name, XLK quite the opposite. And while we have a nominal higher high, or basically really kind of a double top, which technically could be all of this fifth wave of the primary wave three, this looks much more like a 1-2 start to a more bullish extension. So that really is going to rely on holding support in this 2.9 region for the ratio. And if we start to break down from here, then it will be far less reliable as any 1-2 setup for a very, very extended move. But this does allow, and maybe it's only a couple of individual names, maybe it's some of the Magnificent Seven that actually got more beaten up on some of the recent declines relative to the rest of the market that claw their way back and outperform even more. Maybe it's Tesla and that's basically in Amazon and maybe Apple and that's about it. Or a bunch of other AI names or some other smaller names that we're tracking. I don't know exactly what the exact makeup is of this potential move. But the potential is there, even if the broad market is not necessarily participating, for some outperformance in technology off of recent lows. So that would just be more potential extension versus starting to break down and show signs that this was a more significant top, which I don't think we have any evidence of yet. But it is possible, it is valid to count it that way because it did get a higher high. So that's why I have this as green, as implying that it is the far more bullish potential. One last chart that I thought we would take a look at is the XLE versus RSP. So this is going to be, I don't know why it wouldn't let me do the SPY when I was trying to set this up. It's probably just a glitch in motive wave. But I actually like the way that it looks as the equal weight version of the market, the RSP. So a lot of our individual energy names count as a third wave here, held a wide flat, but pretty relatively higher as a fourth wave, and are working on a fifth wave up in a larger primary wave one. This looks a little bit too big, like some of the individual names that dropped a lot deeper, where it already looks like a primary wave one and a primary wave two, or an A wave and a B, but only 3 waves up into that November 2022 high, but then a deeper and wider retrace than is reliable to be a fourth. So they can actually be starting the next larger degree swing move, which maybe either an ABC of a third and a diagonal, or just maybe an ending diagonal itself as a measured move C wave. But really good potential based on the structure of this chart for energy to be outperforming the rest of the market. Can even get a possible 5 wave move up here off of either of these lows. So a retrace would be welcome to get back to about the 0.26 region as a possible wave one and a wave two in whatever, or an A and a B wave if this is going to be an A of the ABC for wave three. But nice potential there for some energy names. Not this all the same market that we saw in XLE and XOP names back here in 2020 and October 2021. But still plenty of bullish looking charts if we can get some nice consolidation into those support regions that we would be excited about. So I think I left enough time to cover a couple of questions. If there's not, I do have one or two other charts that we could take a look at. Um,
There are a few questions.
Great. Thanks, Jody.
Okay. What do you see for semis, SMH, or NVIDIA?
So those I think I have my SMH chart pretty well updated. Now let's go to the SOX chart. Um, Very possible, like everything, very possible to count completed moves in multiple degrees, even a completed five waves up or completed fifth wave off of the April 2025 low. But depending on how you count the subwave structure, this really should have been an ABC that completed, but maybe this was just a wider flat for this as a wave four, and this is working on a bigger extension here. So there's some names in the semis that are very, very different from everything else and that could drag things lower. But it certainly looks a little bit bullish, at least off of the more recent March low. And if we can hold 3620s, then at least there's the potential here for getting further extension. I think this is very much a sector where you really have to look at each chart on its own more so than as a whole.
Okay. Next question. Is gold over Bitcoin a useful ratio?
I do like looking at Bitcoin in gold terms. Again, I'm using GBTC and GLD to smooth out the continuous contract issues. But this is a really nice wide flat consolidation. I don't know if this is a clear five waves up that completed as an impulse. So I'm not really certain what degree, whether this is a wave two or a B wave. But off of this low, the ratio has a pretty decent looking five waves up into expected Fibonacci pinball resistance for wave one of a bigger third wave or C wave, and is filling out nicely as a ABC consolidation for a wave two into fib support. Hit a long enough extension to be all of a C wave, but it doesn't have a clear five wave move down, and it did hit a 618 retrace, but this could still be part of a 4-5 bounce to get lower into the 0.07 region. But there is certainly potential from this support region for Bitcoin to outperform gold again.
Thank you. And how does BE look to you in the energy space, if you cover it?
BE, oh,
BE?
BE. It's not one of my favorites. It's one of the ones that dropped way too low for this to be a fourth wave. So it already counts as the primary wave two and an ABC up with this extension. I mean, the problem is that it's already hitting fibs that are typical with being all of the third. So at this point, this is too small of a consolidation to reliably call all of an intermediate B wave, and for this to be a 1-2 extension of wave C of three. But that is the most bullish interpretation, is that this is just all of the B wave. But this purple alt is certainly concerning, where you're in the fib zone that you normally associate with being all of the third wave of a diagonal. But the fib structure here is clearly still three waves up. This isn't really a 4-5 in its own right. It would just be an alt 4-5 of the C wave, whether it's the C wave for all of this primary wave three or the C wave for just an extension of this parentheses A. But I think we've kind of gotten too far for it to reliably still be the A wave. So the next bullish extension next bullish potential is that this is wave one, it holds around 111 as a wave two, and then probably tries to extend into the 600, 900 region. But there's a lot of energy names that are have a lot more clarity than this. And we prefer the ones where it looks like we're filling out an ABC for a fifth wave as opposed to being awkwardly in the middle of a third. E and B is a little bit similar to that though, where this 2023 low was clearly the wave two in a larger diagonal, and it filled out five waves up right to a 764 for the A wave of that primary wave three. So that's the only reason why I would still allow for BE to be the A wave still, because this chart is a lot cleaner and it counts best that way. But it again on its own, it's not really reliable that way.
Okay, and the last question is, do you cover rare earths?
We do. The charts are a lot thinner for the rare earths themselves, and so we can't really zoom in and get as much granular detail as we can on like a silver chart. But we do post those when they're requested. There's a lot of the rare earth minor names that we track a lot. MP is one of those names that we like if it can hold some support here for a possible fifth wave up starting off of the November low. Really needs to just hold the 54s and has some great upside potential from there.
Okay, so that's it. That's it. All of Zach, your offer can be found at elliottwavehub.com versus offers. All of the presenters' offers can be found there. If you want to join Zach's Stockwave service, please go there and you can find his offer. Great presentation today, as always. Thank you
Thank you,
for
Jody.
joining us, Zach.
My pleasure. My pleasure.
Yeah,
Just
always great.
also a reminder that you can get a 25% discount on the metals mining and agriculture service when you add it to Stockwaves.
Okay, that's great. I'm just posting. Okay.